Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shub, and together with my partner and co host Patric, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. Hey Patrick, I see you're back to wearing jackets for Practical Nerds.
Yes, you kind of, by copying my style, you kind of talked me out of it. But then I said, hey, you know what? Shub doesn't get to decide what I'm wearing, so I'm back on the train.
Exactly. Each of us gets our own little veto on our jacket. That's the extent of our veto power.
And anyway, we're just pretending anyway to have a free will when it comes to our fashion choices, because I have a feeling that the women, plural, in our lives might have a little bit more to do with that.
100%. I think you only pretend like you're wielding the veto, but someone else gets to wield it over you. That's how life works.
By women plural, I mean family, not multiple wives. So just want to make sure I live monogamously. Is that a word?
Yeah.
Yeah, good.
Yes.
Well done. I'm glad. I totally nailed this intro, by the way.
Yeah. What an intro. What a colorful intro.
We're going to talk today about metrics. My metric is wife equals 1. What metrics do you want to talk about?
So not a few episodes ago, we spoke about burn, interestingly enough, and we spoke about how burn is often a reflection of how good companies or how effective the companies might be in utilizing cash to get to certain objectives or get to the next milestone. So I think one idea we had for this episode was to understand what those milestones even look like. When is a company considered to be worthy of a seed round, worthy of a Series A round? What does that even mean, I guess, to be worthy? Why certain metrics matter for certain models and for certain other kinds of models? Very different metrics need to be looked at. That's kind of what we had in mind for this episode.
Yeah, and I think we've been triggered by it very, I think, frequently, just by nature of the job, the profession. It's something we deal with every day, but the external trigger also frequently has been when I've been with founders outside of deal-related discussions on other podcasts, meeting them socially, etc. It does happen regularly that founders ask, hey, what are you looking for at a seed round? What are you looking for at a Series A in my model? And sometimes it's related for them to actually get into our minds and prepare for perhaps that next fundraising and bringing us on as partners. Sometimes it's also, I think, more broadly curious how different investors use different metric frameworks to get excited about specific models or not. So we took that as a trigger to actually say, hey, let's take those out of the one-to-one conversations and into the one-to-many or two-to-many conversation onto Practical Nerds. So I think that's been the trigger.
Yeah. Great. So where should we start, Patrick? We've identified, broadly speaking, 4 different sets of models. Each obviously have their sub-classifications as well, which I would imagine cover most, not all, but most construction tech companies we come across. Where do you think we should start?
So let me give the overview. We'll discuss today the traditional model, software as a service, short SaaS. Then we'll discuss marketplace models and what metrics matter to us there. Then the outcome as a service model that we've been minting and printing and writing and speaking a lot about, with obviously all of it in the context of architecture, engineering, construction, and supply chains. And then we'll take a step at a 4th one, which is financial services. Outside of that, there will be other models that you can run your company with. But for the sake of just limiting time somewhat, we'll stick to these 4. And then our stages are pre-seed, seed, Series A. We do our follow-on investments also later, but I think there are better people, better qualified to talk about what they look at, like a Series B, C, D, E, F. So we'll skip those and we'll focus on seed and A rounds today. So think of it
Yeah.
like that matrix. Let's start with SaaS. And actually, I want to first make the point that within SaaS, the way we look at it has become nuanced depending on whether you build a product that is targeting enterprise or mid-market, so call it enterprise SaaS, whether we're looking for SaaS that is targeting the SMBs out there, or whether you're actually in a third type of SaaS, which I think is not talked about often enough, and we call that the high minimum feature set SaaS. We'll reveal what that is. So let's stick to those three first, Shub. How about you kick us off with enterprise SaaS? What is the things you look for? And I should say before you go, there's terrific frameworks. It's a long invested category. So we're not trying to reinvent now with this podcast what enterprise SaaS should be valued upon, etc. We'll just give a condensed view of some of the metrics that have mattered more to us.
Yeah, I was about to say this is perhaps the most well discovered or best understood category as far as what the right metrics are. Very high quality investors have been investing successfully here, which is why they've also been in a position to develop their own benchmarks and frameworks. So we are kind of standing on top of their shoulders, basically, to kind of give you a very long, short and condensed version of it. Look, long story short, what we would look for in a very traditional enterprise sales kind of a business would be, firstly, the overall scale of the ARR, that is annualized recurring revenue. Key thing to call out here is a lot of times ARR is randomly used when it is not ARR. Again, just to clarify, true ARR is where it's recurring in a predictable way for the whole year. So if it's recurring only for the next month, that is also not true ARR. That's more like MRR. Some people may multiply that times 12, which is fine. That's annualized revenue, but that may not be ARR. And
That is so
it's truly
important
a
to call
subscription.
out. So important to call out.
Correct. Now, that is not to say any non-recurring revenue isn't valuable. It is. It just doesn't fit the ARR. It has to be treated differently. So coming back, we look at ARR and total revenue, the rate of growth of that ARR or revenue, the gross margin, which I think, again, is perhaps not discussed enough. Quite often people treat all kinds of SaaS. They even try to get away with calling, say, a 40% gross margin business as SaaS, right? My personal opinion, I think worst case, 70% is where things can start to be called SaaS. I think it needs to be at least 75%. And most, let's call them pretty good SaaS companies, will start at 80% gross margin. The one asterisk there is, more recently, if you're a business which relies very heavily on processing power, server power for building AI models, you may have an upfront cost. Obviously, but there, at least what we would look for is some ability to quickly get up to 70, 80+% gross margin and not be beholden to others who are contributing to high COGS, because then you're not really getting the benefits.
Quick side note on the gross margin, and then I'll give the mic right back to you. I have recently heard of one of the big LLM incumbents. Google it, you will find out which one, having a negative gross margin on the operations of their business. I'm not talking about training. I'm not talking about preparing the models, training the models, developing new models. I'm talking about allegedly that big LLM incumbent has a negative gross margin on actually letting users use their model. That to me would be actually, as a shareholder, very concerning. Back to you.
That is crazy. That is crazy, right? Some of the other metrics that we look for. By the way, there's different buckets. I guess in the interest of time, because we're different so many models, I'm covering the headlines. Perhaps we can choose to double click on any of the points we would like to. On acquiring customers profitably, what we look for is the LTV to CAC ratio, or the lifetime value of the customer divided by the cost of acquisition. What you're typically looking for, if you're a well-run enterprise SaaS business, is for that ratio to be greater than 3. That doesn't mean if it's less than 3, it's game over. It's just that you might be still early, still figuring out a predictable kind of acquisition channel. I think if you're at seed stage, as long as you have a very viable path to get to above 3, that's fine. I think at Series A, at least I would expect the ratio to be higher than 3. Because in my opinion, if you haven't yet got to that ratio of 3, you're probably still not ready to be called a Series A company.
So for me, Oh, sorry, Shub.
There's a few more, but perhaps I'll pass the baton over to you so that it's not a monologue.
So there's not much I can dispute. For me, it is perhaps slightly different weightings that I give enterprise versus SMB, seed versus Series A. So I'm a stickler for distribution motion. And so I look in the metrics for sales efficiency and capital efficiency. In a seed company, I might have early indicators of that, more so in SMB than in enterprise usually. At a Series A,
Yeah.
I will be able to judge the capital efficiency and the sales efficiency in both enterprise and SMB at Series A. One of the under discussed metrics, it's such a powerful heuristic that encompasses how you run your entire company in a SaaS model, is the ARR to FTE. It will reveal so much at a Series A stage, not seed stage, but at a Series A stage, on whether you actually deliver product efficiently, whether you actually can extract distribution power and be efficient there, and overarchingly, whether that leads to a high capital efficiency or a low capital efficiency. So the ARR to FTE standalone doesn't tell me something, but as an auxiliary indicator, it actually paints oftentimes a picture left or right. What is this company to me? So that is one that I can only endorse. Any kind of founder, both enterprise SaaS or SMB SaaS in the AECS space, post your seed round, start tracking it. It will reveal a lot for you. And then with regard to distribution motion, sales efficiency, and the overarching capital efficiency, go into the SaaS frameworks. You will see what I'm looking for, but that's where I put a lot of weighting. Now, when I go into the seed rounds, here things are slightly different. So let me, between enterprise and SMB in AECS. So SMB in AECS, I can't expect a net dollar retention, call it cohort, of your dollar retention of north of 100%. If as an SMB type of play you have that would be totally mind-blowing whenever I see that. But if you're north of 85, 90% net dollar retention on an annual basis, that's pretty awesome. On an enterprise level, people would call that pretty underwhelming. So there, what would be exciting, most investors, including us in AECS, is if you're north of 120, and totally exceptional, north of 130% on an annual basis. A second thing, so in enterprise, I actually like annual contracts or even 3-year committed contracts. I think if you can extract that, even with an upfront cash flow, and I've seen that actually happen in AECS enterprise contracts, especially the last 2 years, you should do it. And when I see that, I kind of like it for its ability to extract cash flow. On the SMB side, I actually hate annual contracts simply because it will not allow you to get a true and accurate picture of your churn, and it will actually make your product decisions and your distribution decisions too slow. So actually in the early years, so seed round and then the 1 or 2 years after the seed round, I will typically prefer if the SMB software company will go for monthly contracts only, in order to get a super live type picture of the cash churn that happens to my product, and from there do all the iterations that I need. So that's another nuance here that I like to call out. Now, there's a third type of SaaS, Shub, that we have backed, and we call it the high minimum feature set. Let me just briefly describe what we mean and then hand it back to you. So high minimum feature set are products that need to build oftentimes for years to match incumbent products for customers to be truly commercially adopted, not be adopted through design partnerships or pilots or like one-offs, but truly be commercially adopted. And AI doesn't shortcut it. It's just you need to build a very broad functional suite of features in order to be truly commercially useful for your customers. Now, in these instances, I cannot judge a Series A the way I judge a Series A in enterprise SaaS or even SMB SaaS in AECS. So what do we look for?
So this is actually one of the harder ones to specifically pinpoint a set of numbers or metrics on, but taking the liberty to perhaps describe it more loosely, what I'm looking at seed is that there is a clear value proposition for a growing cohort of customers for whom that solution is mission critical. And what we mean by mission critical is that they have clearly gone out of their way to deploy resources to make sure they're tied up with that solution. Either they have uploaded a ton of data, they're using that to create projects, create workflows that they intend to pull back into their work, and they have perhaps brought their colleagues, teammates, other people they need to interface with also into the platform. So in other words, if that platform were to go away, it will materially affect their work or their profession, uh, mind you, with or without revenue. So this is all happening perhaps even with a free product. In fact, in all likelihood, with a free product. This is what I would like to see at seed. Now, at Series A, it gets, interestingly enough, it's just a slightly more scaled up version of this. What I would like to see is a predictable motion of enhancing this or growing this cohort, where you get to a stage where there's 5 to 10 referenceable clients of a certain size, assuming it's a solution which applies not just to SMBs, but to, let's say, slightly larger customers as well. You found a repeatable motion to get these users or clients into your platform, embed them in your platform, and who swear by you. And you found this repeatable method to get them in. That is when I would say, okay, you're now Series A ready, again, with or without monetization.
I'm looking at it from a similar direction. So first of all, I just want to double underline one or two things and then build on what you said. So number one,
Mm-hmm.
if you pitch me that you're a high minimum feature set SaaS, and that's how I should evaluate you, that's the first thing that I will actually look for, whether that condition is true. Because a high minimum feature set product will mean that you will encounter very little other startup competition.
Yes.
Because it needs to be so difficult and crazy to build on a technological and product basis that you will be almost alone against the incumbents. Not truly alone, but almost alone. Whereas in other SaaS, you
Mm-hmm.
might have 10 competitors vying at a seed stage for the same customer, 5. Here, you might have 1 or 2 competitors vying for the same customer with the same proposition outside of the incumbent. So that's the first thing, right? So don't fool yourself. High minimum feature set really is a high bar to be in that
Mm-hmm.
kind of space. 2, I will look for both at seed and Series A. I will look for lock-in and distribution. So lock-in, what I look for is metrics that reveal to me that there's an insane customer love. And that could be derived from mission criticality, especially at a Series A. At a seed, I might not be mission critical yet, but aspects of the mission that I help my user achieve are deeply loved. And basically, they take the Sean Ellis test and they say, hey, how disappointed would you be if I actually went dead tomorrow? If you have like 50%, 70% of your users say very disappointed, that's a pretty interesting metric.
Mm-hmm.
That's not the only one. Another one that you will see already oftentimes in these types of companies at a seed stage is the weekly active users to monthly active users will be very,
Mm-hmm.
very high, like 50%, 70%. So that's
Yep.
another one. And the usage cohorts in these first 1,000 to 5,000 users will be so the 12 weekly cohorts that I have seen in these types of companies is again north of 50%, oftentimes north of 60 to 70%, which is
Mm-hmm.
like that is very, very good. And so that indicates
Yeah.
customer love to me. Then I will look for metrics of stickiness. So how
Mm-hmm.
difficult will it be to churn away from this platform once I have truly adopted it? So I will look oftentimes for a data flywheel where the more data I upload, the more powerful the platform becomes for me. So that's really important. Um, So that will tell me a lot about, hey, is this actually a product that will be loved and sticky with customers?
Mm-hmm.
And then finally, what I will look for at both seed and Series A is, to your point, to build on what you said, I will look for an insanely efficient distribution motion. And the reason is, if I have to invest a lot into product, I should not have to invest a lot into distribution. If I have to invest a
Yes.
lot into both, most likely I will just be a black hole for capital. So I need to
Mm-hmm.
have the leverage on the distribution side to work
Mm-hmm.
that way. Community-led growth motions, I'm absolutely in love if they work. And for example, in architecture engineering, I have seen them work. It's a community made for that. So yeah, that's when it comes to high minimum feature set softwares.
Agreed. Yeah. Should we move on then to marketplaces, Patrick?
Let's do it. You're the marketplace guru. I just want to remind everyone, you led the original seed round in Zwork. You led our first investment, earliest stage, in Inframarket. You led or co-led the pre-seed in Metalbook, if I remember correctly.
Yeah.
Yeah.
Mm-hmm.
So and a few others. Offload in Australia, which is the better convoy for Australia. So you have a lot of B2B marketplace
The
experience.
better
So
convoy.
I'm gonna prop my ears now. What are you looking for?
Okay. I mean, by the way, thanks for all that flattery. Hopefully it gets you somewhere with me. So, 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 so look, it's actually quite interesting. I think, the the interesting thing is, I think in marketplaces, quite often we come across companies who I think make it seem like it's too arcane and mysterious, and hey, these sets of metrics are what should be looked at seed, and this is what should be looked at Series A, and the range is extremely wide. But the truth is, I think it's not. I think at this point, at least from our vantage point, we feel like we have seen enough and figured out a few recipes, if you will. So I think we have a pretty tight handle on what we are looking for. So actually, what I'll perhaps do is start from Series A and work backwards from there, because unlike in SaaS or software businesses, there's an aspect of how much capital is at play, which kind of determines what the targets might be for seed. So for Series A, what I would look for typically, and we're talking now just for everyone's benefit, we're talking about a marketplace where there's a GMV, which is the value of goods or services transacted. There's either a take rate or a margin component to it. You may or may not be deploying working capital to enable the transaction, et cetera, et cetera. So what I would look for typically is at Series A, at least $1 million US in monthly GMV, right? And again, just to repeat it, that means 12 million annualized GMV, which is not the same as 12 million ARR. Just for all of my marketplace founders, please don't refer to it as ARR. If you're watching this podcast, and if you've interacted with me, there's a non-negligible chance you've referred to your GMV as ARR. So please don't do that, because it's not ARR, right? Okay, so 1 million monthly GMV. To be honest, the margin by itself, I don't think it's a firm metric. So what I like to look for is margin in conjunction with working capital or the payment terms.
Yes.
So in other words, the higher the margin, the more leeway you get on how much of a working capital burden you're carrying.
And the
So
other
maybe
way around, the more working capital you deploy, the higher the margin expectation that we have for you.
Correct. Exactly, right? So whichever is the constraint in your business, it therefore then defines what you need to do on the other side. So for example, if you're operating in a business where you can only extract lower margins, say low single digit margins, you better make sure your working capital cycles are either very low or negative, right? And what I mean by negative is you get paid first and then you get to pay your suppliers later. As an indication, for example, if you're operating as a 10% contribution margin, and what I mean by 10% contribution margin is you've subtracted cost of goods sold or cost of sales and cost to serve, which typically in these businesses would be logistics costs, any other handling costs, etc. So once you have subtracted all of that, suppose if you landed up at 10%, I would think like a good range for the working capital exposure you should have for a business like this is in the 30 to 60 days sort of range. What that means is uh, you can take that much longer to get paid because your margins in your business are relatively high. Now, the tricky part here is that means that imposes an additional liquidity requirement on the business. You need to carry an extra 30 to 60 days of your monthly turnover on your balance sheet, which is why I said it's a capital play that also guides how much you raise, how much you are supposed to do at seed. Yeah, again, taking a step back, if you're a negative working capital business, you can support lower margins and you can go back and forth from there. Think of it like if, for instance, you are a 10% contribution margin business operating off of a 60 working capital days structure, you get 6 turns of the business in a year, approximately, of which you can rotate it and extract maybe 60% yield on the year. That's one way to think about it. And I'm not saying 60% is what you need to aim for. It could be lower. But if, for example, you're getting to less than 20% by doing all of this in a year, you're in a spot of trouble, or less than 30%, I would say.
And all of this matters because I look at it from 2 angles. One, it defines how quickly you can grow. So if you need a ton of working capital, but you also generate a ton of cash from it, it can still work for you to grow very quickly, access more debt very quickly, grow very quickly. It can still work if you hold very little working capital and you're almost modeling your marketplace as, I call it, an infrastructure type play. You can still be a managed marketplace with very little working capital. We've seen those. But because you have an insane repetition in your processes, in your distribution motion, you can almost become an infrastructure type play. Not quite like a fintech, but you're moving more into that direction than being working capital heavy on the managed marketplace side. And that allows you, with very little working capital, to then grow very quickly. Where your growth will be impeded is if you use a ton of working capital with very little cash flow generation because your margins are too low. So then that will be the first impact of not getting the working capital to margins ratios right, is you will grow very slowly. And the second is, so once you move towards IPO or towards exit, we are learning this through our portfolio, have learned this through our portfolio, is that the multiples that you can extract will unfortunately be very, very different. And the multiples are not as nuanced as what we're discussing right now. They will be more looking at your P&L than at your cash flow statement, which in my opinion is insane because the true power of a business is measured in the cash flow statement, not in the P&L. But that's the way the IPO world at least will work. So at some point late in your journey, you might need to add working capital, or you might benefit from adding working capital, at least at that point, to boost your margins in the eyes of the multiples that the public market uses, right? But you don't have to start there, is what I'm saying. You can also load your company later, but you need to prepare mentally for, hey, that might be a step that is worth doing. So that's one reaction. The second one is, I have learned to love for both seed and Series A type marketplaces what we call the ROCE on working capital. So ROCE on working capital, the way to calculate it is basically saying, and sorry, the reason why I mention now how to calculate it, because this is literally not published, whereas all the SaaS metrics that we discussed and glossed over, like there's so much documentation out there, just read it, everybody will know what we're talking about. This one is not. So ROCE on working capital in a marketplace, basically what you do is, you can do it with your gross margin, but better to do it with your contribution margin. You take the contribution margin as the return, so basically the nominator, and the denominator is the working capital that you need to deploy. You multiply it with the number of days that you keep it. You then put it in relation to 360 or 365 days, and that gives you an annualized interest rate for the margin that you earned on the working capital that you deployed. And so when that number, now giving away maybe a little bit of a state secret here, but anyways, I think it's fine. When that number is above 20%, you want to throw working capital at your contribution margin. When that number is above 50%, you're a fucking money printing machine. And we have seen it more than once. It works. It's one of the most so I've never seen a founder actually give us that metric. I think no founder marketplace is run that way until we point that out to them. Except maybe one that we have seen in India that is more of a financial services type materials marketplace than a materials marketplace. But once we point it out to founders, to co-investors, they are like, aha, like a light bulb goes up above their head. So and we have seen then, once we have done that exercise with founders, multiple of them are above 50%. And that is a money printing machine. You want to raise as much debt as you can and throw as much working capital at it, because you can earn an insane amount of return that none of your investors will usually earn on any of their investments and assets and holdings. And all you do is keep the working capital for 30, 50, or 70 days. It's a pretty liquid way of printing money. And if your business is in that state, you have an unbelievable business. So above 20%, great. Take more working capital. Above 50%, you're insane.
Yeah. Absolutely. I mean, the interesting thing in that both of us are saying, we are focused more on the Series A metrics, and I think it's not a coincidence that's happening, because as both of us are realizing, and perhaps our viewers are noticing the common trend here, there is a capital rotation or capital deployment aspect to how marketplaces function, which is why, whether we like it or not, it is a function of how much capital you're going to use to get to wherever you need to be at Series A. So the truth is, there's no right or wrong answer for where you should be at seed. The question is, to get to the state that we described, say 1 million. I mean, 1 million, I would say, is the floor. Obviously, if you're higher, even better for you. Monthly GMV with all of the dynamics we described. If you need to raise 1 million, then you can work yourself backwards and pace yourself accordingly. If you feel like you need 2 or 3 million, that will accordingly shape how much you need to raise at seed. The one caution that I would provide here for marketplace founders, if you believe you need to raise more than, say, I think even 2 is somewhere in the borderline, but let's say for the sake of this discussion, if you believe you need more than 2.5, 3 million to get to the state that we described, you may want to revisit how you intend to execute. And for more notes, please check out our episode on managing burn, because this is precisely why burn and figuring out where you're deploying the capital matters, because otherwise you may be in an early stage burning away too much cash to get to a state where you're not fit for a Series A. And you may be running head on against expectations that you cannot deliver to.
So here, one of the justifications that you might give yourself as a founder in an AECS marketplace is, but Shub, I need to build software. Time out. Time out.
Exactly.
Oftentimes you do not have to build software to build a managed marketplace. Now you might want to build software as you go along, but I want to eliminate one of that I have encountered to be one of the biggest misconceptions that is driven by especially fallacies and convictions from B2C marketplace people, founders and investors who invested in B2C markets. So in B2C marketplaces, these folks have made the correct experience that, hey, we want to automate everything. We want to eliminate human touch points. We want to, as much as possible, make sure that every single transaction, both the exchange of cash, but a transaction is also a user perhaps placing an order, doing something in my software. Every single transaction is as much automated and repeatable as possible, because I am dealing with small AOVs, I'm dealing with relatively high churn, and I am dealing with millions and millions of transactions a day. Makes sense, but it does not make sense in a B2B context. And unfortunately, these mantras of automating everything and minimizing the amount of human touch points is exactly the wrong recipe for B2B marketplaces. In B2B marketplaces, in AECS, architecture, engineering, construction, and supply chains, you do not want to limit the amount of human touch points. Okay, here's an example. So one of our portfolio companies is doing monthly reviews with their customers about the intended purchase volume in the categories that they serve for 30 days, 360 days. And they also say, hey, let's agree on the price bands against these volumes. And as long as you stay plus minus X% within the volume you forecasted for me, the price will be valid. But once you go outside of these volumes that you forecasted with me, the price will change. And so that provides a strong visibility on the true demand. It also provides credibility towards the customer that you are committing to something that is custom to what they are doing. And it's these human touch points that actually inject track record into the AECS model that you're running. And track record is defensible. It is what allows you to extract 10, 30, 50% of market share in categories in AECS. This is not unheard of. This actually happens, guys. So if you run your managed marketplace with the intent, that perhaps your consumer marketplace friends would tell you, minimize human touch points, you would miss out on all of this, and probably you wouldn't even get to a point where you can even become a category creator. And so that now means, though, that for your the metrics that you look for and the software that you need to build in the early days, there is not a ton of software that will define whether you're delivering a great outcome for your customers. So the software can come later, and you will identify which parts of the human touch points you want to keep human and which parts you perhaps can embed better into software. But oftentimes that decision, if you approach it the way I've just laid it out, is not best taken at day one. And that means that you don't need as much cash to justify to yourself, but Shub, I need 5 million to build the software. No, you don't.
So I fully agree with what you said. I think we often overlook, or it's often overlooked, that in B2C commerce, for the most part, for an overwhelming majority of the use cases, the purchase is a discretionary purchase, certainly not critical to the everyday of the buyer. Whereas in B2B commerce, and certainly true for the AECS marketplaces that we have backed, these are all the lifeblood of the businesses that buy from these platforms. And so, I mean, automation may be nice and all, but what they're really looking for is consistency and predictability, and that there is no random failure, random price changes, etc. And they would rather trade in certainty over automation, as long as something that they're familiar with works.
And they look for one more thing. I can speak here from the European perspective. Perhaps it's similar in your region, Shub, is oftentimes the suppliers that they have, except for very, very large categories, it's a too fragmented supply base, and they hate that. They actually want to enable suppliers to take 10, 20% of their spend in order to have less management complexity.
Yeah, absolutely. Absolutely.
Okay, so marketplaces. Let's talk about outcome as a service. I can kick us off here.
Yes.
So outcome as a service, we describe, and so Google it. We have talked about what that model means to us and why it is so awesome, actually, in AECS. But in a nutshell, it is awesome because it delivers a guaranteed outcome to a person that runs a project under high risk of failure and high consequences of failure. And that's why they love if you can guarantee the result rather than just give them tooling. And that's outcome as a service. So when you run an outcome as a service model, I will typically evaluate closer to being a marketplace than to being a software as a service, but not exactly like it, because you're often your own supply. So I can't run any kind of supply side cohorts or supply metrics on you. I also can't run the SaaS metrics because most likely the margin on any given project that you have is insanely high, but you will typically have a higher cost of distribution for the next euro that you need to sell, right? So that's the whole point of SaaS is, hey, retention is cheaper than acquisition. So on ours, I will have retention, but it won't look the exact same. What I will look for to get myself excited in an OAS company is early net profitability. That is a very strong first indicator whether you can actually deliver margins into a buy-ready market and you can control the outcome. And so if you then show me net profitability in 1, 2, 3 months, that's all I need to get myself interested in digging deeper. And then I will look for repeat purchases from the same customer. And then I will look for, hey, is the outcome that you deliver, is that a custom service? And every time you deliver it, you need to do something different? Or is it actually standardizable, repeatable? It just happens to be purchased as an outcome. And if it is standardized and repeatable, then these three things are already enough to get me excited to spend more time.
Yeah, I think not a whole lot to add. In my opinion, the way I see outcome as a service, I think it does boil down to being a service. So therefore, depending on the manner in which it is administered, sometimes it may resemble a marketplace more closely. Sometimes it may resemble a software company more closely. But if you peel all of those layers aside, and if you just think very, very old school, services are always meant to be very high margin because it's meant to be a simple markup over time and labor or time and materials. In this case, it'll probably be more time and labor. And therefore, it is likely to be high margin. And so just as in a very conventional way of thinking, you don't expect to run a services business with a burn, you should not anticipate beyond the early setup phase. You should not plan for an outcome as a service business to be burning money beyond, say, the first few months and some initial setup costs involved. What I would look for, especially, is the predictability aspect of what you described, because if each incremental client or each incremental project needs a lot of customization, then it's probably a more traditional service business, not something that has the benefits of scale or is a venture style business. What I would look for is a very predictable, repeatable method of administering the service or delivering the outcome. And that can take different forms. What that entails specifically, frankly, depends on the use case, depends on the manner in which the service is administered. But that for me would be the number one and number two criteria, the profitability and the predictability / repeatability of the method.
And then there is 2 or 3 more things that we have learned to appreciate as we looked more and more and invested more and more into outcome as a service, which, by the way, I think we still get ridiculed by VC friends for investing in outcome as a service. But I also have like 50% of my friends now actually write me, hey, actually, this all makes sense. I think I'm getting conviction here. And we've been doing that for 2 years and have been ridiculed by some people for 2 years. And now they come on our side. So since we've been doing that for a while, I think we've also figured out a few things that inform us today beyond what we just discussed on outcome as a service. So the first one is an OaaS business, you judge on contribution margin, not on gross margin. So gross margin in a SaaS model is oftentimes considered one of the holy grail type metrics. If you're above 85% or you're like Autodesk, 92%, wow, awesome, people get excited because they can benchmark you. It does happen under certain assumptions in a SaaS model, though, and that is that the sales efficiency and everything that happens on your marketing and sales is somewhat comparable. That's when people use gross margin. Now, in OaaS, actually, it's not comparable. And so I have seen outcome as a service models with gross margins of 40 to 50%, but a contribution margin of 35 or 40%, because it literally is, I put my product in the window and it gets bought. It just very, very easy to sell it. I have also seen outcome as a service models with 85% gross margins on delivering the outcome, and yet a contribution margin of 35 to 40%, because the sales motion to get there can be quite difficult, or because the repetitive buying behavior is only once or twice a year. So an outcome as a service, you need to judge it on contribution margin. And if your contribution margin is north of 30%, you're in a very, very good place. You might have something going on here, but you will be there because one of the two things, delivering the outcome or distributing the outcome, is repeatable. Now, if none of the two is repeatable, you will likely not end up in a place of 30% gross contribution margin. So that's one point. The other one with regard to outcome as a service. So outcome as a service, if your delivery of the outcome spans across more than 1 month, so if it takes longer than 30 days, then typically you will carry a project backlog or an order book, let's say, and you will carry your realized revenue. And the two of them, if again, your order realization is more than 30 days away, they will actually disconnect at some point in your numbers. And so what you and I have learned, and we've discussed it at length for many years behind the scenes, is, hey, it's actually a very useful ratio to divide your realized revenue in August 2024 by the order book in August 2024. And oftentimes this kind of freaks people out because they say, hey, but these two are not connected. I realize the revenue next month or the month after. It does not matter. The point is not to take a snapshot in August The point is to see how they trend. So you do the same ratio in July, you do the same in June. And now if your band goes close to 100%, it trends close to 100% over time, that means you're not closing enough contracts. That means that probably you have a problem selling right now. And it means that you might be overstaffed on the people that deliver your product. Now, if you're over these 3 months, for example, your ratio trends down, let's say towards 50%, it indicates that you're selling too fast, you might not be hiring enough, or you might have efficiency issues and not enough software automation on delivering the outcome, right? So the trend is your friend, dividing your realized revenue by your order book in these types of outcome as a service businesses. Final point here, what we have found is every business has a sweet spot ratio of realized revenue to order book. For some of our companies, it's in and around 72 to 75%. And if they maintain that, they grow in the right amount of revenue towards the right amount of resources spent on delivering the revenue. For your outcome as a service business, the sweet spot might be slightly different. It could be 60%, it could be 80%, but there will be a sweet spot for your business that you better figure out.
Correct. Yeah. I mean, for example, some of our businesses that are outcome as a service also are involved in home building, for example. There, the optimal ratio is more in the 40% odd ratio, simply because there's only so fast you can build a home. So it does take time.
Months.
Exactly. Yeah.
Okay, fascinating.
Nice. Yeah.
Final one here, financial services. So perhaps we should first define it, because there is a big range of financial services. Shub, are we talking about infrastructure type plays here, or are we talking more like invoice factoring?
So maybe I'll give a quick preview of what kinds of financial services plays we've seen in AECS at Fundamental. This mostly includes companies we've already backed, but might include some others we have evaluated but not yet backed. So first would be lenders, basically either lending off of your balance sheet or lending off of a third-party institution providing a credit line. So as in, you provide a loan or a purchase financing for some products or services that are otherwise offered on your platform for a fee, right? If you're lending off of your balance sheet, obviously you expect to earn interest income, which is your primary revenue driver. So that would be from the lending side, let's say. Then we have seen firms solving for payments infrastructure. This could be cross-border payments. This could be domestic payments as well between suppliers, vendors, merchants, etc. Then we have seen a few plays on the insurance side, either for insuring, by the way, one hybrid of payments and lending and a little bit of software that we have seen. We have such a firm in our portfolio. Is kind of doing all of this, providing a software solution for factoring/early payments. We have a solution like that as well in our portfolio. Coming back to what we said about insurance, I have seen a few plays around insurance of workmen or workforce, field force in construction, seen solutions for insuring truck personnel based on how they drive or based on the details of the trips they undertake while driving trucks. We have also seen more specific kinds of insurance products. For instance, more recently, check out our colleague Fabio's article on surety bonds, which obviously is one specific type of insurance product. So we're always interested in new age insurance products as well, tailored to specific markets. And apart from that, I'm thinking, is there any other financial product I might have missed, Patric?
Maybe just the infrastructure type model, where basically you provide more or less payments infrastructure, maybe in an escrow type way.
Yeah. So think of the kind of network that a few decades ago the likes of MasterCard and Visa would have had to create to enable payment processing, or what the likes of Stripe has done more recently to enable payment processing as well. Creating a similar sort of infrastructure to enable real-time payment approvals and escrow mechanisms between, so imagine like a material supplier located in a country with suppliers in another country, employees somewhere else, clients somewhere else, some other third-party service providers in another country. So you have to pool together payment workflows across maybe 5 or 6 countries in a single operation. So we've seen companies doing that as well, solving for these payment workflows.
So when it comes to I want to perhaps bundle the first types of companies together, and that is the purchase financing, material financing, or the other side of that is invoice factoring,
Yes.
which I want to bundle together. So here I'm going to treat these companies I'm going to look at these companies at a seed and Series A stage very similarly to how I would look at our managed marketplaces in architecture, engineering, construction, supply chains. You don't have to build a ton of software just yet. Make sure you have sufficient human touch points. Make sure you care about your track record, because these people that are your customers, they operate under risk. They operate under time crunches. They operate under cash flow crunches. And they don't want to go to a fancy BNPL startup backed by 5 people who run a podcast discussing politics. They want to deal with people who are actually entrenched in the business and who know how risky it is to trust a new supplier. So forget about investing too much into software in the early days, just deliver the outcome. And that's what makes it very close to a managed marketplace. So here, the ROCE on working capital will be a metric I will look for as well. Same answer I gave here during the managed marketplace is north of 20% is good, north of 30% very good, north of 50% absolutely insane. Load more debt, load more working capital, load more facilities that you can deploy in these kinds of models. So that's one of the things that I will look for. And the second one is I will look for repeats. And here the problem can be, if you run such a business within SMB, your customers might not start a new project every month. And so that means that if you're not deliberate in choosing your customers when to onboard them, you might have a lot of active accounts with very little activity, just because the timing that you went with when you picked them was not particularly good. And I know of this dynamic because it is a project-based industry, and because in SMB type clients, I won't have a portfolio effect of their projects. I'm aware that your cohorts will never look the same as in other models. But if you prove to me that you're actually not aware of this, and I will see that in your cohorts, then that's a problem. The problem is not the project type nature. The problem is you're not managing it well. So I will look at the cohorts, especially in an SMB type financial service play like that, from that angle. I'm judging you as founders, not your business in itself, because the business is what it is. In an enterprise type financing play that way, your cohorts should be very good. You should be starting new projects to finance every month. With
just to add to your point on tech, while I agree with you on tech by itself isn't either a differentiator or something that needs to be built, I think the crucial detail here, especially if you're a business choosing to lend off your own balance sheet, is you need a clear framework and a process for what is the basis of your underwriting. And you're also able to communicate this in a way where it's credible in order for you to raise more debt. Where what you're essentially trying to communicate, hopefully through some track record, hopefully through some credible examples, is that you can achieve a higher yield than other debt providers, while also keeping the delinquency rate either low or hopefully zero, but in realistic terms, very, very low. Now, a lot of new age, let's say B2C lenders have traditionally turned to using tech to demonstrate this. What we found is that doesn't work as effectively in AECS tech, certainly not with the current state of readiness. So, what that means is you need to develop a methodology and a set of processes which gets the job done and also can be communicated to lenders. Obviously, this doesn't mean you reveal your secret sauce, but is believable by banks and lenders to extend debt to you.
I love the way you phrase it, methodology and process. One of the most important ones here is actually having feet on the ground, going to the construction site, shaking hands, looking around what is happening. Believe it or not, that is one of the most important aspects to your credit underwriting model if you're going after SMBs in this type of financial services play. And then If you have software to then collect information from there or to guide your feet on the ground, great, but just software is probably not enough.
Agreed. Yeah.
So that's on bundling these types of models. And we're nearing the end of our podcast here.
I would say, Patrick, even the insurance kinds of businesses, I would package along with the financing businesses. Because even what we have seen with the motion of these kinds of businesses, what you're looking at essentially is there is a value of products provided. There is a certain proportion of value which you get to retain. And just like in lending, you're underwriting the risk of a bad event happening. Okay. So I would also package them similarly.
I can tell you one metric that I'm absolutely not looking at in these financial services plays, and that is the vanity metric of GTV or gross underwritten premiums or something like that. Completely irrelevant. Yeah. The only thing that matters here from the revenue perspective is just the net revenue. And actually, perhaps we stop this. Well, this turned out to be relatively long. Perhaps we stop this one here with one funny thing. Shub, explain to us what a take rate is and why it's not the gross margin.
Oh. By the way, I'm glad you brought this up. This is one of my pet peeves. Yeah. I don't know if you face this all the time. It really annoys me when people use it interchangeably. Yeah. So firstly, people use GMV and ARR interchangeably. Then they also use take rate and gross margin interchangeably. They're not the same thing at all, people. So let's clarify what one means and what the other means. So firstly, in general, you cannot have both a take rate and the gross margin on your GMV. On your GMV, you either have a take rate or a gross margin, right? So you have to first decide which applies. So if you have a gross margin on GMV, what that means firstly is that you are a supplier on record. So let's take the example of ride hailing. So Uber, although Uber is not the supplier on record, this may surprise some people, but it is not the supplier on record. The supplier on record either is the driver you have or some transporter who owns the car. So for that transporter, actually, you know what? Let's take it as Amazon versus Uber, right? So if you're Uber, the way Uber makes money is if you take a ride, Uber will take a proportion of the fare of the ride as their revenue, right? So Uber, in other words, is not a GMV business, it's a revenue business, right? So the first thing to clarify, and their revenue is a take rate of the ride value. You may choose to call it GMV, although purists will tell you that is not the GMV.
Yeah.
That is because Uber does not receive the invoice with the overall ride fare value. It is not the supplier on record. So their share is the take rate, which is also the revenue. Now, they may have certain gross margin underneath that, which is their cost to serve, etc. But the ride value is not the GMV. Their take rate, which I think in Uber's case is about 25-30%, that is the revenue. Now compare that with, say, Amazon. So if you buy, say, shoes, right? So say you buy shoes of $100 from Amazon. The $100, which is the GMV, depending on the accounting methodology, might also show up as Amazon's revenue, because Amazon is, for the most part, except for, I think they have one of the business lines, but for the most part, is the supplier on record, in which case the $100 will show up as Amazon's revenue and also the GMV. Now, Amazon will have cost of goods sold here, which is the cost at which the seller of the shoes is willing to offer it, some logistics costs, perhaps some marketing costs, etc., direct marketing costs or promotional costs. When you subtract all of that, you're left with a gross margin. Mind you, there is no take rate involved here because Amazon is the supplier of record. What you're left with is the gross margin, right? So this is basically the difference. So in other words, if you're the supplier on record, what you should be reporting is the GMV and the gross margin. If you're not the supplier on record, you're just a party in between facilitating transactions. What you could report GMV, but be warned, we'll ask you, hey, is that the GMV? Is that the value, etc.? And what you're reporting basically is then the take rate.
Yeah. And there's two ways how founders can misappropriate this. So if you're a managed marketplace, a supplier on record, and your gross margin is, let's say, 5%, you might try to tell us, hey, my take rate is 5%, so really awesome. And we're like, nah. So that's not how it works. If you're a marketplace, but not a managed marketplace, you're not the supplier on record, you might apply the gross margin that you generate under your net revenue. And you might say, hey, my gross margin is 95%, but then we might say, hey, but in a managed marketplace, actually, you wouldn't be exactly coming up with that because, depending on GMV, it might only be 1%. So
Yes.
just make sure that you're being consistent within your framework and you don't try to compare with the other model. So compare and benchmark yourself within companies that run the same model.
Mm-hmm.
Great.
Absolutely.
Shub, I think this was a great quick run through. We started lightly with the well-documented SaaS, and then we came more into the spaces that are less documented, and I hope it was helpful for folks listening in. Little ritual here. What is exciting you in your calendar next week?
A little bit more of the same from the previous episode. Hitting a very strong patch of opportunities in the regions I cover. So quite a few opportunities, new opportunities we're digging into. A few interesting follow-ons happening as well in the portfolio. So perhaps, I think a reflection of the rebound in the economy or rebound in the macro, I guess. Perhaps also a reflection that some of our companies are finding their next the next stage in their growth. So pretty excited all around about the level of activity.
For me, looking to close that company that I mentioned in the last episode, and I got excited I got invited, and I'm pretty excited by a very, very large podcast platform that reports on GPs and fund managers, and they invited me back in. I've been there before,
Nice.
just discussing how to build differentiation as a GP and as a fund manager. And first of all, it's a terrific platform that they built, but also it's exciting just because it forces you to think about everything that you have been doing. Hopefully a lot of that was deliberate, probably a little bit of it was luck, and it's this like forcing yourself to think again that I'm quite excited about.
I mean, I'm sure you enjoy speaking more with them than you do with me, so good on you for that.
That's okay. I'll let you get back to the women in your life, tell you all the problems about your fashion, and I'll see you next week.
Look forward to it, sir.
Cheers.
Cheers.